The yen hasn't really indicated anything other than the effect of the collapse in the euro-yen cross and the other carry trade crosses around the financial crisis of 2008. Nothing the Japanese government has done since then, until very recently, has had any effect. So it really has been the euro that has been the indicator, the signpost, the most moving, the currency that moves the most in its pair with the dollar when we have other events or other things happening in the world. Now, I'd like to ask anyone who has any questions. I will keep the chat up. Please put them up as we go forward, and I'll be glad to stop and go off on tangents. Anyone who's been to my webinars before knows that I tend to go off on tangents anyway. So a question may help to rein me back in if we have any any topic that anybody's interested in. So let me change screens here. Where's the euro? Here we go. We're talking about the euro. This is a 5-year chart for the euro. It's one that we're all familiar with. But there's an interesting fact of this. You know, we have been talking, and commentators, I hear it all the time. They call it the RORO world. Not a very elegant way to phrase it, but that just stands for risk on, risk off. Much of the commentary has been how different this world is for trading than the old central bank focused world. The old or the prior method of analysis. The greatest correlation in foreign exchange trading and in the movement of currencies has always been related to central bank rate cycles. Everything feeds into that. Will the central bank raise rates? Will the central bank surprise the market? Sometimes they do, very rarely. Although less so, much less so now in the United States under Ben Bernanke than they did under Alan Greenspan, the author of my favorite, or the originator of my favorite market quote. I know I've used this. I use this every time, but I like it so much. If you have clearly understood what I said, I must have misspoken. Alan Greenspan liked to keep the markets guessing. Mr. Bernanke does not. But the idea that central banks determined the interest rate, the directions of currencies, turning points when they change their cycles and who's moving first, is one that it seems on the surface we've gotten away from. So when you had not interest rates, but any economic statistics, policy changes, the way they entered into the foreign exchange market was through speculation on what the central bank is going to do. Will this make the Bank of England more likely to lower rates? Will it make the Bank of England more likely to raise rates? And on down the line. That is very different. So this is what we're looking at here. Now, people have said that, and it is true, that over the past year, 2012 was not a very good year for FX volume. FX volume went down. Trading volume went down. But looking at this Euro chart, does this look like a bad time for trading? It does not. In here, and you know, I even heard this morning. I was listening to Alan, the Bloomberg surveillance show this morning here in New York, and they had on Alan Ruskin, who is a he's chief, I think, market FX analyst for Deutsche Bank, probably the biggest worldwide foreign exchange bank. I don't know them, I've never met him. His stuff is very good. I have read it. It's very sensible. It's not overly technical. It's large macro pictures, and he's talking about trends. And one of the things that he said, which I don't agree with, is that there have really been no trends since the financial crash, the financial crisis of all of 2008. Does this chart look like a chart without trends? It does not to me. It looks like a chart in retrospect, of course, full of trading opportunities. I think what Mr. Ruskin was saying, and I should hesitate to speak for a man who is so well versed in the markets, that what has changed is not the volatility. It's the ability to predict trend movement from central bank rate policy. Notice I said central bank rate policy. That has gone away, and we can all look at the reason why. We'll just look at some 30-year, where are the U.S. generic 5-year bond. Central bank rates. Okay, this is a 30-year chart of the U.S. central bank rate. Well, we all know what that is. It's been 0.25 since then. Look at the UK. These charts are going to be boringly familiar and also the same. Look at this one. This is my favorite, of course. This is Japan. If there's ever been a better indicator of the inability of central bank rate policy alone to spur economic growth or economic recovery, this is the chart. Japan has effectively had zero rates for almost 20 years. Japan is not doing well those 20 years, not as far as economic growth goes. And of course we have the ECB. This is the, we should call that the Trichet bump. This was also the Trichet bump. Mr. Trichet used to like to raise rates. But we can see the reason that the euro, not the euro, but central bank rates are no longer, as Mr. Ruskin noted, I wonder if he's related to the 19th century British art commentator. Anyway, never mind. Why they're no longer tied to central bank rate policy, because central bank rate policy is not moving. All of the banks around the world, to a greater or lesser degree, have taken the same approach to the financial crisis, the recession, and the ensuing debt problems around the world. Make money as cheap as possible and hope it does some good. It probably has done some good. It probably did stave off a lot of disaster. Nevertheless, it is not sufficient by itself to spur economic growth or really to create a recovery. But Mr. Ruskin's comment that the years since the financial crash have been trendless, he didn't say trendless, but they have been without many pronounced trends, is not one that I agree with. Look at 2009. Euro from above 1.5 in 2010 to 1. That's a fine trend. Again, reversed, other way, down again. These are absolute trends with an enormous amount of volatility, of course, that you can trade. But the difference is that it's not central bank rate policy that is driving this.